Let's talk about the EV bubble that is going to happen in a few years. This video is really ahead of its time because right now, EV is probably the hottest sector on the market and everyone is jumping in there to make a quick buck. And here I am being Debbie Downer and telling you that the EV bubble will burst a few years down the line and how you can prepare for it. This video is perhaps, in my opinion, 3, maybe 7 years ahead of its time. So let's get started. So 96.4% of you haven't subscribed yet. It is free and you can always change your mind in the future. And this month, I'm looking to help 20 professionals without a financial background to master investing and target 30% a year. So there will be more details at the end of the video. So first, there's something you need to understand about startup. When I was in business school, there was one analogy that really stuck with me, and that startup is a graveyard. And the graveyard is probably the last place you want to visit. But if you want to understand how other people or companies have been killed, then you need to study the graveyard. So before we dive into the crash, let's talk about where we are at today. So then we lay down some ground rules and facts. So as of 2020, Tesla has approximately 18% of market share in the EV market. Now, depending on which website you're referring to, this number might fluctuate a little bit. Kathy Wood said Tesla's market share is around 26%. The article I found is around 18%, and last year was around 20%. So that's what you're going to be looking at, somewhere between 18 to 26%. And when you look at the black table I have shown here on the left-hand side, you'll find that the top 20 EV makers consist of 80% of the market. Here is the first big question for you. Do you think the EV market is a winner-take-all market? If it is a winner-takes-all market, then you need to be careful because this is the first red flag. Because imagine Tesla is taking around 20% of the market. There are so many EV startups out there. What is left for the smaller companies? So let's dive into the EV market. Now in China, there are over 120 EV companies at the moment. And I have went on Wikipedia and have counted it. Because startup is always changing. There are always going to be more EVs than what is reported on Wikipedia. So if it is based on my estimates, I guess we're somewhere between 200 to 300 EV companies worldwide to date. Now, interestingly enough, there's actually a section called defunct companies, which means these companies no longer exist or they're not in the EV market anymore. And 36 companies are defunct as of today. And that is actually around 30% of the EV companies. So you can see the default rate or the defunct rate is actually quite high already. Number 3, the overall industry is losing money. So here I summarize a couple of stock ticker symbols and their revenue and profitability. And here you can see that other than Tesla in the latest quarter reported a profit, all the other EV companies are losing money. And when you're looking at their market share, other than NIO and Li, where they have over 100 million in terms of sales, and they're still losing money, all the other companies have way less in terms of revenue. And as of right now, there are a couple of companies down below that I don't have data yet because they recently got IPO'd. Pretty much, you can guess that they're losing money as well. That's why they need to go IPO. And the fourth red flag is really the way these companies are going IPO. Now, in the recent years, there's a new trend where a private company will acquire a publicly listed company in order to go IPO. And that is generally a faster approach to go IPO because you skip some regulatory process, and it also allows you to go IPO even though you're not exactly making money. And that is SPAC, and it is very speculative, and a lot of people can make 10 to 1, 20 to 1 return by investing in these speculative shell companies that might become an actual company by being acquired. And when you look at the EV market, more and more companies use this approach because they're not profitable. So you can see that there are a couple of red flags here. Now, one argument is that EV is such a new market. Of course, all these companies are not profitable and it only makes sense, but we are investing in the future. So even though they're losing money today, they wouldn't be losing money tomorrow. Now, at the same time, you also know that the other big automobile companies are moving into EV as well because obviously China has mandated all vehicles needs to be electric by 2035, if I remember correctly. And this basically gives them a big push towards EV. And here is the fifth red flag where Elon Musk said to his employees that we need to control costs to maintain profitability. When you're looking at the automobile industry, it is actually quite interesting because it has a relentless focus on costs. So many years ago, Henry Ford developed the assembly line manufacturing process, which brings the cost down. Elon Musk encourages his employees to submit ideas so then they can produce Tesla at a lower cost. When you think about this industry, there are a lot of automotive manufacturers that are already producing cars very cheaply, like Toyota, Honda, Hyundai, and you get these new startups trying to compete with automotive manufacturers. And there is a reason why automotive has been an oligopoly for a long period of time. An oligopoly means that there are only a few major players in the market. And this is really because EV is expensive. When you think about startups, they're going to have a hard time controlling their costs, so the risk of default is going to be very high. So to understand the EV bubble better, we really need to go back 20 years ago to the dot-com crash and understand why it happened, what is the change in stock price, how much did it drop, and what triggered it, and what you can do about it. So the first question is, how much will it crash if it does crash in a few years? So to illustrate my point, I'm going to use Apple as a case study. Now, Apple back in the day was already a relatively large company. During the crash in 2000, the stock price dropped by approximately 60 to 80% in a matter of months. So here is the chart from TradingView, and this chart actually includes all the stock splits afterwards for the last 20 years. So that's why the price is so low. So as of August 2000, the price is $1.1 for Apple. And then in September, it dropped to $0.4, which is a 63% decline from August. And November, the price is $0.35, which is a total drop of 68% decline from the top. And in December, it was 20 cents, which is an 81% decline from the top. So that means if you're unlucky when you're investing in the EV market or whatnot, and the EV bubble burst, you can lose up to 80% of your stock value within a very short period of time. And that's exactly what a bubble is. And there's also a possibility that you might lose everything because the company actually gets delisted or it goes bankrupt. So the next question is probably, well, how long is it going to crash for? Like, if it is like the coronavirus market crash, it actually recovered within 6 months, so there's really nothing to worry about, and I'm just going to hold. So when it comes to the 2000 dot-com crash, the recovery period was actually 4 years. You can look at the chart on the left here, and the stock price has stayed low for 4 years before it reached the August 2000 price again. And you also need to consider that some of the companies you invest in, the EV companies today, will not exist 3 to 4 years from now. So let's dive deeper into the dot-com bubble and understand what is the trigger. And during that time, it was actually very simple. The Fed was increasing interest rates, and here you will see the interest rate for the last 25 years or so, and it just went from 5 to 6%. And Wall Street got spooked out. They thought that the technology company cannot afford the higher borrowing costs, so then they start panicking and selling. And when you look at the grand scheme of things, from 5 to 6% is not even a large increase. But that was enough to trigger the dot-com crash. So here you can see that the market is actually very fragile. Even though the interest rate didn't really increase that much, it was enough to trigger fear in the masses and cause a panic sell. So now you have a good reference point. Let's take a step back and understand what is the life cycle of an industry. If we go back approximately 100 to 120 years, then you'll be at the beginning of the automotive industry. And as of 2020, you're at the beginning of the electric vehicle industry as well. So back then, there was 1,500 automotive companies. And there's actually a list of them on Wikipedia called the list of defunct automotive companies, and you can look that up, and I've counted them as approximately 1,500. And 90% of these don't exist today. Probably more than 90%. Because as of today, there's less than 20 major automotive companies. Toyota, Honda, Hyundai, Audi, you get the idea. Well, other than the automotive industry, why don't we also look at another industry? The search engine industry. Now, most people today know search engine as Google. But back in the day, there were actually 200 to 300 companies that were developing search engines. But now, Google has over 86% market share when it comes to searching for stuff. And here you can see that search engine is a winner-takes-all industry. And this is really because of the algorithm, the software that Google has developed. And it is extremely difficult for other companies to copy it. And keep that in mind because we're going to come back to that point. So the big question for EV is really, will there be an oligopoly? So let's look at some of the big oligopolies in the world. For Google, it's search engine. For Microsoft and Apple, it's operating systems and computers. For payment solutions, back in the day, is Visa, MasterCard, American Express. And for payment solution now is PayPal and Square for digital payment solution. So when you think about new technology and new industries, you always start off with a lot of little companies. And over time, 80, 90% of them will die, got acquired, go bankrupt, and only a handful of these companies will remain, and they will take majority of the market share. And that's what I expect for the EV market as well. So today, we have over 120 EV companies in China, probably over 150 worldwide. And in the future, there's going to be less than 10 EV companies. And these 10 EV companies are going to include the automotive companies today, like Toyota, Honda, Volkswagen, and all those people. So you can imagine how competitive the industry is going to be in a couple of years. So don't get me wrong, there are going to be a ton of millionaires created in this process, and there will also be a ton of people lose millions as well. Because when you're looking at a stock price, you can already see that it goes from $10 to $50. So people are 5 times, 10 times, or even 100 times their money in this process. But if you know that a few years from now, or maybe 5 to 10 years from now, a lot of EV stocks will not exist anymore, and only a handful of companies will remain, then people who are millionaires for investing in these stocks and people who are losing millions of dollars, this is basically a transfer of wealth within the society. And this really goes into how these millionaires are created. Normally, when you invest in a company, you think of yourself as the owner of the company. So the company will grow, the company makes money, and you get a return for it. But if you invest in a failed company and you still made money, how is that possible? So let's say you got into a junior EV company at a cheap price, let's say $10, and it has gone up to $50, even though the company is losing money or it has a very little amount of revenue, and the stock price still went up 5 times. And that is really because other people are jumping into the roller coaster, so then the stock price has gone up. Now, of course, if you're lucky and you got in at $10 and you made 5 times, then you can cash out. But this cash is really just coming from other people in the country or in the world. The company itself did not generate a single dollar of profit yet, so it is basically a zero-sum game in the short term. It's only when you look at the long term, where the company is making money, that the pie is growing bigger and bigger. So what does that mean? It means that for every millionaire created by investing in failing EV stocks, there will also be people losing $1 million as well. Because unless the EV stock you invest in actually makes money in the future, this will be a direct transfer of wealth between people. So that's why I think the EV bubble will burst somewhere between 3 to 7 years from now. And this video is really ahead of its time. So maybe after 5 years, we'll come back to this video and see whether I was right or not. And probably the top 3 to 5 EV companies will still be around, but all the other smaller EV companies are either dead in the water or they're no longer relevant anymore. So I'll see you in the next video. So when it comes to investing for myself, my goal is to make around 30% a year. And initially, this seems like an ambitious goal. And I mainly focus on investing in big companies that are stable, not like EV stocks where it might go bankrupt in a couple of years. And it took me around 8 years to crack the code. And when I cracked the code, it's really about answering these 9 questions successfully. So I have laid them out for you. If you want to be targeting a higher return, or you wonder why you're not making money, then you want to have really good answers to these 9 questions. And even though these 9 questions seems like they are separated or not together, they're actually interconnected. So this includes what's your stock selection process, risk management, portfolio management, entry, exits, and profit multiplying mechanism. And how do you deal with a market crash, for example, the EV bubble burst? So if you want me to take a look at your strategy and see if there are any opportunities for improvement, then send me your response at eric@5minuteinvesting.com. I think I have over 400 responses to date. I think I stopped counting after a while. So just send it to me and maybe we'll even hop on a call in the future. If you're interested in how I invest in the market and how I answer those 9 questions, then you can grab the 4-hour free training on my website. So this is perfect for you if you are a full-time professional without a financial background and you want to manage your own portfolio and learn how to get 30% return. So the link is 5minuteinvesting.com/free case study. And in terms of Investing Accelerator, this week we got Bruno made 32% from Chef in 80 days. Chris made 50% from work, which is Slack, in 6 weeks. And Mike made 61.5% from Disney and 11% from Schwab in 4 months. So those are fantastic returns. Congratulations to you all. They're all veterans within Investing Accelerator. So these are multiple success stories that have come from them over and over again. And in terms of Investing Accelerator, this month, I'm looking to help 20 professionals without a financial background to master investing. The target is really to get 30% return a year. And the stretch goal is 30 people. That's how many people I can handle on a maximum scale for this month. So if you want to secure spots and join the program, watch the free case study, and then you can schedule a call with me. In terms of the giveaway for this video, I have selected my favorite book, The One Thing by Gary Keller. So if we reach 100 likes for this video, and it is free, just tap like and say you want it in the comments, and I will announce the winner when we reach 100 likes. I'll see you in the next video.